Hi, everyone. We are here to discuss impact of high interest rates on valuation for alternative investments. And I have a esteemed panel here. I will ask them to make an intro. Steve, go ahead, please introduce yourself and the phone.
Yes, my name is Steve Rosen, Senior Manager with Ackerman Associates. I've been doing audit and some tax work for investment management companies for the last 20 plus years.
Awesome. Kamil.
Good afternoon, everyone. I am the CEO of the GRC Investment Group and the onshore corporation here in the States, Global Realty Capital. We are a single family office, operate out of United Arab Emirates with a global mandate. We focus on alternatives, and specifically we are heavyweight on commercial real estate globally and on renewable energy and waste management. I'm happy to be here in my capacity as a macroeconomist and also with focus on global financial markets. Happy to be here again.
Thank you, Kamil. Thank you for being part of our webinar today. Jeff, please.
Hi, my name is Jeff Miller. I work with JCSD Capital. We're a financial services focused hedge fund, manage two funds under the banner, but they're very similar. Been managing money since 1997, primarily focused on banks and even more specifically US based banks since 1994.
Awesome. Thank you, Jeff. So let's discuss some housekeeping items. In order for you to get CPEs, you need to answer polling questions 4 out of 6, and you will get your CPEs within the next week or so after the webinar. And Akram is registered with NASPA, and we offer these CPEs at free of cost. So happy to help here and share knowledge on this topic. Okay, so let's start our discussion today. As everyone knows, it is a complete regime change from 0 interest rates to above 5%. It was happened so quick within a year, everyone was shocked. And because of this interest rate increase, every asset class is seeing the impact. That's why the stock market, equity market, bond market, every asset class was down last year in 2022, and we have seen some progress in 2023. Things are settling down. Fed is close to the high. They may stop, they may pause, they may increase. We don't know, but at least it was a regime change, and every cost of doing business is high. And because of the interest rate, there's a big impact on the economy and all that. So my first question to Jeff, how do you see the interest rates impact overall on the economy and especially on the financial sector, because you're highly focused on the bank stocks?
Sure, yeah, so and I should have mentioned too, in a prior life, I managed dividend growth funds and value portfolios for about 10 years for mutual fund companies, including Calamos and American Independence funds. So these rates do impact not just financial services, but value stocks and dividend stocks in general. But the main impact so far is because they raised very quickly, has been to last year particularly have a significant impact on the valuation of bonds. So bonds and loans have decreased in value about 20% on average last year for government bonds, just because of the discount rate went up so quickly. So longer duration bonds in particular have decreased in value significantly since the Fed started raising rates last March. The secondary impact was to have, and it didn't really come into play until March, was when the impact hit some of the bank stocks and the banking companies, because the value of their bonds had decreased significantly. So they became capital light, and Silicon Valley Bank shares and Signature Bank shares in particular were the two that were impacted the most. So it's also, throughout the economy, And Camille probably can speak to this better, but you're seeing an impact on real estate valuations, particularly the ability to roll commercial real estate loans that are coming due at this point, because a lot of loans were made at 3.5% to 4%, and those loans are now going to be underwritten at 7.5% or 8%. So that has an impact as well on just overall real estate valuations.
Thank you. Awesome. Camille, the same question to you. How do you see the impact of the interest rates on the investments you are managing?
Definitely, it has been painful. Even though I believe that the Feds lagged in responding to the typically growing, creeping up inflation for several years. They just came last year and they started this interest increase that took the industry somehow by surprise, because many operators in the industry did not think that we will go that far. We will go from close to zero up to where we are today. So did that impact the income and also the a collection of in the commercial real estate? Yes, and that led also to a drop in velocity where comparable sales are no longer there. In that case, normally in the business, you lose the relative value for any asset, regardless if it is commercial real estate or a combination of a company with real estate or with that. So in the absence of relative value, there is really the industry is heavily impacted. Adding to that, the events of last March in the banking industry that caused even more problems. And then when we see that also the team that is on the fiscal side not fully cooperating with the monetary side, they're adding more fuel to fire. When I see that the 535 people in Washington plus the people in the White House, they're discussing earmarking earmarking projects where they were supposed to be only discussing the interest rate and also the state of the economy to help the population. I'm not very optimistic for the next 12 to 18 months.
Thank you for giving the big picture. What do you think the impact of the interest rates on the investments, particularly in the real estate you're managing? Steve, my similar question to you is because the high interest rate, did you see any impact on the valuation of the investments we are getting involved with our clients? Do you see they are valuing the same? Are they reducing the valuation? What is the overall impact of the interest rate you would see?
No, so the overall impact is, if you're doing a present value calculation and you're picking up the higher rates, right? Your present value calculation, you're bringing actually the valuation, even though it sounds counterintuitive, but you're actually bringing the valuation down because you're getting less bang for your buck on the future value of these companies that you're trying to value, right? So we've seen, if we're lucky, we've seen certain valuations stay stagnant, but the bulk of them we've seen them drop by anywhere from 5 to 25%.
Right. Oh, true. I agree. This is overall, I think the trend is towards downward. Okay, awesome. Thank you, Steve. So let's discuss on bonds, right? What do you think, right? This is the area where we think you can educate us and our listeners and participants that how this hike in the interest rate by the Federal Reserve had an impact on these regional banks, and those banks went underbelly and referring here the Signature Bank, Silicon Valley Bank, First Republic Bank, right? Do you think that was because of these available for sale held to maturity bonds that caused the impact, or there was a bigger reason for this, please?
Sure. Yes. So the impact there was, so there's two different categories of bonds that banks carry on their balance sheet: the available for sale and the held to maturity. So the available for sale are marked to market. In theory every day, but in reality monthly is how they do their accounting. So, but they know what the valuations of those bonds are because they're traded, and you can look them up, on your Bloomberg. So the available for sale are marked to market. So as rates go higher, the value of those bonds goes lower. The held to maturity bonds, or HTM is how they're, is the acronym for it, are not marked to market because the intent is that the banks are owning those as an investment in their investment portfolios to generate income and yield for the bank overall. So the theory, and this is how the regulators look at it as well, is that they do not mark the held to maturity bonds to market. They also don't mark held to maturity loans to market from a regulatory capital standpoint. So any mark to market loss on a held to maturity bond does not impact their regulatory capital. Where Silicon Valley got into issues was they had a very large book of bonds, both available for sale to maturity, that they bought when rates were near zero, and they bought the longer dated bonds. So they bought 10-year plus duration bonds, which the longer dated bonds you buy, the more impacted you are when rates go higher. It's just bond math. So if they had bought 2-year bonds or 3-year bonds, they wouldn't have had the mark to market and capital issues that they did. But because they bought 10-year plus bonds, the markdown on those was significant. And so what happened was, actually last fall, bank stock investors were looking at what were the marks on the held to maturity bonds as well as the available for sale, just to see what the actual real book value was of these companies. And then because regulators don't look at held to maturity, it kind of got passed over, and people said, well, that's interesting that Silicon Valley has a negative book value if you mark the whole portfolio to market, but regulators don't do that, so it doesn't matter. And then fast forward to March, and what happened with Silicon Valley in particular was they went to Goldman Sachs and said, we want to sell some of the held to maturity bonds, which causes a whole bunch of accounting issues, because now once you sell one of them, you have to mark all the rest of them to market. But at the same time, they were going to try and raise capital to fill in that loss hole on their balance sheet and basically end up in the same place. Well, they did it backwards. And if this is too long of an answer, to this one question, I can shorten it. But basically, what they should have done was raise the capital first and then sold the bonds. What they did was they sold the bonds, took the loss, and then tried to raise the capital. At which point, everybody looked around and said, "Wait a minute, you mean you're insolvent if you don't raise the capital?" And so they weren't able to do it. And Goldman basically gave them bad advice and flipped the bank upside down. And then because of the speed of Twitter and whatnot, and their investor base being very technology oriented, within a day or so, it got around that their capital raise had failed. And so $47 billion deposits left the bank in 24 hours, and the bank failed. Didn't have to happen, but that was the kind of most extreme example of what can happen when rates go up very quickly. So the Fed, basically raised rates too fast, and something broke. And the thing that broke was, Silicon Valley Bank shares.
Is this a similar reason for a Signature Bank, or was it some other?
Signature was more because of their crypto deposit focus. They were focused on banking a lot of crypto exchanges, and so when FTX and Crypto.com and others were having issues, they lost a lot of deposits there. Plus their focus on commercial real estate in New York City. They had loans to a lot of empty office towers in New York City. So the combination of a flighty deposit base and an illiquid asset base on the other side caused that problem. And First Republic's issue really didn't need to happen. The First Republic's model was to make low rate, very attractive loans to high net worth individuals. So what they did was same thing. Was rates go higher, the value of those low rate loans goes lower. Now again, they're held to maturity, and they wouldn't have to be sold. But what was happening was First Republic, because they focus on such a high net worth in depositor base, the deposits mostly were uninsured. So they were very large deposits, or commercial deposits, over the $250,000 FDIC limit, which made their depositors nervous. And so theirs was more of a slow grind lower in terms of as customers started moving deposits to other banks to get FDIC insurance or to use the CDARS program, which is where you can, leave your deposits in a bank, but also they spread them around to other banks and you get, effectively $5 or $10 million worth of FDIC insurance. It's just more expensive. So what happened with First Republic was it basically became an uneconomical or unviable business longer term. And it was eventually bought by JP Morgan, but that was a slower burn type of issue where they just they were basically in a business that was going to not make money for 3 or 4 years. So it was better for them to be sold.
Right. But do you think because of the new Fed window and the new actions taken by the Federal Reserves after the collapse of these banks, do you think this issue is contained, or do you think it may still continue in other forms and shapes?
No, it's not. I mean, it's been almost 3 months now. So anybody who was going to move their deposits from their bank to another bank has already done it. We talked. There were 2 other banks that were thought to be in similar situations, but they've been updating investors on their deposits basically weekly. One of them, Western Alliance, has actually increased its deposits since March 15th. Silicon Valley was the first week of March. There was some deposit outflow that first week as everybody kind of panicked. But since then, they've actually increased their deposits by $4 billion. So they were the one that everybody was looking at because they also had a large depositors and large commercial focus. But no, it's over. Then the issue isn't going to be deposits in the banking system. I mean, I've talked to probably 50 bank CEOs since March, a bunch of conferences. There was just a Bernstein conference last week with updates. That issue's over. You've had 3 months to move deposits if you were going to do it. That would be a very delayed panic to take 3 months and then go, oh, we're going to switch. And the issue now that people are focused on with banks is really the commercial real estate and particularly urban office properties. What do you do with the office tower that used to host 5,000 workers a day, and now only 1,000 are coming into the office, and they're coming in Tuesday, Wednesday, Thursday. What is the value of that office property is the question investors are asking now. But in terms of interest rate impact, it's still bad because it's in terms of deposit costs, because deposit costs are going up, but the deposits themselves aren't leaving. So what you're seeing from the deposit side is large commercial customers who have a treasurer are going to their bank and saying, hey, you've been paying me 0 interest rates for 10 years. We need to get paid something on our $10 million, check deposit account with your bank. And so the question becomes, do the banks raise that to 2%? They raise it to 3, 4, and what does that do to their net interest margins and their profitability? So it's the question really now for banks is a profitability question. How much are they going to make? What is the ROE going to go from 17% to 15%, or is it going to go to 13%? But it's not going to go negative. It's just it's a reduction in profitability. It's not a capital issue anymore.
Right. Similar question to Kamil, right? So here, Jeff just mentioned about the commercial real estate and also the office space, right? Do you have any investments in that segment of the right, and how you are managing those commercial real estate investments?
You're muted, Camille.
On mute.
Normally for us, Mohammed,
you're good. We can hear you now.
Okay.
Thank you.
In my portfolio, commercial real estate mainly is industrial, life science centers, data centers, self-storage, and senior housing. We are very, I have few investments in office. They are not a huge investments, so the impact is very, very minimal. But being market and engaged as well as the principal owners of assets in New York, in Boston, in Chicago, and San Francisco, due to long-term relationships, they are all feeling the pain and afraid of the outcome. in a recent event, when I say recent, about 2.5 weeks ago at KPMG in New York. The conversation was with 3 panelists of 3 leading funds that are holding and investing into office nationwide. When the moderator, who is a partner at KPMG, asked them, what's your interest in office? Nobody answered. He said, are you looking to buy office at 20% discount? No one answered. I was sitting in the front row. We were all laughing. And then he said, would you buy office at any price? And every one of them said no. So they call a lot of distressed office investments will be coming online, and it's going to be a catastrophe for not only for the owners, but also for the owners and for the lenders. Some lenders are already offering notes, so they can clean out their own holdings, and we know that there will be more notes to come. Some buildings can be converted, and that's a very, very small percentage. I hear a lot in my travel and in the different events I attend about developers saying, they're looking to convert office buildings into hotels or into apartments. This is not real, and that's not true, because very few buildings, and office buildings specifically nationwide, can be converted, originally constructed. But otherwise, you cannot turn an office into anything else but maybe open co-work space, organizational. But how many conference events can you have on one floor? And it's a problem. It's a problem. The lenders can lend and pretend they can demand equity, mark to market, but a lot of people are going to get hurt.
Okay. Thank you, Kamil. So it's time for a polling question. So let me launch the polling question. Within a minute, we will close the poll. So the first polling question I'm launching. Okay, so that was just for the CPEs. It's very simple question. I'm not going to take a time here. Steve, my question to you is regarding the recent fund launches. Have you seen more fund launches from the digital asset class, or the stocks, or bonds, or futures, or real estate? Which asset class you're seeing that more fund launches are happening?
So strangely enough, and again, counterintuitive to what you might think, in the last probably 6 to 8 weeks, we're seeing a lot of real estate fund launches, which again, like I said, you would think is totally counterintuitive based upon everything you're hearing. But a lot of fund, especially emerging fund managers, think that there's going to be a pie of, as Camille mentioned, distressed properties out there to be had. We're seeing a lot of those, and that's both on commercial and residential. For me, I would have expected to see more regular hedge funds based upon the downturn. But, again, for me, it's counterintuitive to see so many potential real estate funds being launched, but that's what I've seen in the last, like I said, 6 to 8 weeks.
And we don't have, just to tell our viewers, that we don't have complete data. We're just seeing what we are seeing, right?
Right.
Other funds are seeing different or but it makes sense to me that because of the this is one of the asset class, real estate. You can't get the fair value right away because it takes time to determine the fair value of the asset class, because buyers and sellers usually take time to determine the fair value. So it is quite possible that people think there is a value in that asset class going to happen. So next question, which is more on the impact on the stocks, right? So Jeff, please educate us, right? There are two type of stocks: growth stocks and value stocks. And obviously, growth stocks are long duration, value stocks are short duration, and value stocks usually financials, industrials, and on the growth stocks are technologies. Stock come usually under biotech. So how do you see the impact into different types of stocks, and how do you see the future or the 2023 shaping up for these type of stocks?
Sure. Yeah. So, last year when the rates really started moving was not good for technology stocks and growth stocks because they're discounted. To your point, they're discounting earnings that are far in the future. So they're like a long duration bond. So you can kind of think of the two types of stocks. Or you have value stocks, which have a high current cash flow, high profitability today. So you're getting cash flows and dividends today. So they're a shorter duration type of asset versus a long duration asset, which is a growth stock that doesn't earn anything today. But all of the earnings are in the future, say 5 years, 6 years, 7 years down the road. So you think of like I think I'm not a growth stock investor. I'm not a tech stock investor. I focus on value stocks that have cash flows and real assets. But you can think of like a Tesla a couple years ago wasn't earning any current income, but the stock became worth $1 trillion literally, and based on future expectations of cash flows. Or the meme stocks 2 years ago, the AMCs of the world and the Best Buys and whatnot that were trading at valuations that didn't really make any sense. And since then they've both filed for bankruptcy. Actually, Best Buy has, but Bed Bath and Beyond. So similar symbols. So you look at the growth stocks that they tend to be very highly impacted when rates start moving higher. More recently, tech stocks have had a comeback because rates have stabilized. So on the expectation that the Fed is done raising rates, you've had a remarkable recovery in those longer duration growth stocks over the last, I would say, few months. Technology stocks have really recovered quite strongly, and value stocks have actually been impacted. So you've had this dichotomy where now the ratio of the QQQ, which is the tech stock ETF, to the SPY, the kind of overall market ETF, is actually nearing an all-time high in terms of its ratio of one to the other. So growth has really outperformed value year to date, which is maybe a little counterintuitive. In terms of the interest impact on stocks, if rates go up slowly, so not the way the Fed did it, but the way they should have done it, which is more gradually, not go from 0 to 5, but go from 0 to 1 to 2 to 3. Value stocks tend to do fairly well because the impact on their cash flow discount rate is fairly muted, and the companies have time to adjust. Financials in particular like higher interest rates because it should be better for net interest margins because a lot of their deposit base doesn't pay any interest. But again, that's in a gradually rising rate environment where the depositors don't necessarily pay attention to the rate increases. So if you go from 0 to 1 over the course of a year, it's not that big of a differential. You're not seeing a lot of people moving money. You go from 0 to 5, everybody goes, wait a minute, I'm getting 0 still. I want something on my money. So that impacts their net interest margins more so than a higher rate. If you had gone from, say, if we were already starting at 4%, which used to be normal for CD rates, and you go to 6%, you don't see that much of an impact on deposit costs. But all the floating rate loans that are tied to prime or tied to LIBOR or tied to some benchmark reprice higher, and so net interest margins expand in a normal environment. Because we were at 0 for so long, there's been a lot of distortions in valuations of assets, whether they're real estate or bonds or whatnot. you had $19 trillion of negative yielding debt in Europe for 5 years. So European banks own that, and that's a big issue if you own European financial stocks. And European insurance companies still own debt that has a negative interest rate, which is ridiculous. So you have to really dig into each bank individually. There's a lot of banks that are mostly floating rate asset holders, so higher rates are definitely better for them. There was a bank called First Republic, held almost entirely fixed rate mortgages. So even though there was no credit risk in their mortgages because they were high net worth individuals, they had a lot of embedded interest rate risk. So that was an extreme example of a bank that took the opposite bet, and it was a wrong bet. So.
Right. So, but how do you see? We have seen a lot of recovery in the growth stock in 2023, but value stocks are still after they were doing okay before a bank collapse or Silicon Valley Bank, but after that I see value stocks are also not performing well. But how do you see between now and the year end, which type of stocks will perform better? Both?
Yeah, I mean, because also in value you have, it's not just banks, obviously, it's industrials, utilities, high dividend paying kind of old economy companies, real asset owners, that, self-storage companies, those types of companies are all doing very well. My personal view is that the shift and, if this money flows, the money flow from value last year into growth and technology this year is becoming extreme. All of the gains in the S&P 500 year to date are concentrated in 6 stocks. If you take out the FANG stocks, take out Apple, Facebook, which is now Meta, Google, and a couple of other companies, the rest of the market is actually down year to date. And so you look at the value sectors have not performed well. So people who pick up the paper and aren't necessarily looking at this every day, see the S&P 500 is up, they see that the NASDAQ is up a lot, and they go, oh, everything must be doing well. But actually, if you look at the equal weighted S&P, which instead of market cap weighting, which the S&P 500 is market cap weighted, so those 5 or 6 large technology companies represent now 25% of the market impact on the S&P 500. If instead you equal weight it, it's actually down year to date. And again, that ratio of equal weighted S&P to market cap weighted S&P is reaching an extreme level of where it tends to mean revert. Now that is the nice thing about markets, is they tend to be mean reverting toward, from one extreme to the other. So I do think that you're going to see a pretty extreme mean reversion out of, where money flows out of technology and back into financials. Even if you look at the last 4 days, banks are up 12% in 4 days, which you wouldn't know, pick up the Wall Street Journal, you would go, oh, okay, but you're starting to see some of that money flow back into those value sectors in the last few days.
Okay, awesome. Kamil, I know that your roots are from the Middle East, and most of the companies over there are value companies, right? Value stocks. You might not have a lot of growth stocks or growth companies over there. How do you see emerging market as the interest rates are topping here in the US?
The impact can have different shapes. There are, in the emerging markets, there are countries whose currency is pegged to the US dollar.
Mm-hmm.
The pain was a lot less. But for those that have to convert their currency to meet their balance payments in US dollar, to make the conversions, after how we saw that the increase of value of the US dollar, that changed the formula for them and turned it upside down, and to create a lot of instability and much higher inflation and increase in the cost of food and energy than we have seen here in the US. And look, the problem started really back in, the problem, like I said earlier, has been creeping up slowly, because as we are adding population to the world economy, there has to be an adjustment to inflation, and that's where we were lagging as countries of the leading world. Now, 2020 was we were hit by the pandemic, and the pandemic kind of disrupted that trajectory of growth that the United States had experienced for many consecutive quarters, for many years. So we knew that was coming, but we did not know it was going to be caused by a pandemic, that whole thing. Now, after the pandemic, we had policies that disrupted the cost of energy and also opened the door for inflation. Later on, we had a year later, we had a war in Europe that is causing damages for the economies of Europe and the emerging markets, and ultimately also the premier market, because the premier market is the one who does not have the technology, does not have the money, but all they're doing, they're producing an increasing population on daily basis. So all that is really impacting the emerging market, in a big way. Adding to all, we had during the pandemic, we had shut down economies, and then we had, if you remember, the Suez Canal blockage that for 12 days we put the world 6 months behind in supply chain. And for someone might say, well, just one barge can stop the Suez Canal and cause all that damage. Well, because of the backlog, definitely. And then leading to that increase of value of the dollar, the emerging market is hurting. Today, when I'm asked about the emerging market, there is only one country that I can name that is is an existing destination for investment, which is India. But out of India, there is really nothing around there that attract an investor, an LP in my position, to place capital for diversification and to leverage my portfolio. So emerging market is hurting. Premier markets is hurting even further, not only due to what I mentioned, but premier market is more affected, negatively affected by the war in Europe, that they are not getting energy, or they are getting any fertilizers. So they cannot grow food for their own people. We are going to see a lot of poverty and famine beginning of 2024.
Wow. Scary things. Hopefully not, but
I don't mean to bring in the doom and gloom, but you know what? We are realists. We can only tell our audience, and then when we talk among ourselves, to speak reality. Today the situation does not look good. Does not look good.
Okay, this is the time for the next polling question. So I'm going to launch the poll. Okay, awesome. So the next is equity risk premium, right? So this is a term, Jeff, most of the fund managers use quite often, right? Tell us, to our participants or listeners, that how with the excessive interest rate hike, is the equity risk premium is doing better or worse for the investors?
How is it doing right now? You said versus history?
Yes.
Again, there's always the answer. It depends on which stocks you're looking at. So the value stocks are offering, quite attractive risk premiums right now. Again, talking about financial services stocks, because that's the area that I tend to focus on. You're you're able to buy high quality banks that are earning, 15, 17% returns on their capital for 4 and 5 times earnings. So you're getting a 20% return on your investment upfront, current earnings return today versus a 5.25% Fed funds or a 4.5% 10-year. So right now the equity risk premium in financials is extremely high. It tends to not be that high. It tends to usually be about 5% for banks. Financials typically trade at 10 to 12 times earnings over a cycle. And if you have normal interest rates, which we haven't had for a long time until recently, were say 4.5 to 5%, you'd have a typical equity risk premium of about 5% for financials. For value stock, utilities tended to be have a lower equity risk premium because they were regulated, more highly regulated in terms of what they could earn. So they were kind of a guaranteed return. So their equity risk premium for utilities tended to be in the 2 to 3% range because it was more bond-like. So the closer you get to being a bond, where the cash flows are more certain, the lower the equity risk premium. The more uncertain the cash flows tend to have a higher equity risk premium because those cash flows may not be there down the road. So, from an equity standpoint, you typically have utilities at one end of the scale. You should have small cap, unprofitable growth companies at the other end of the scale because they may never have a return. They may never pay a dividend. They may never make money. So those tend to be at the other extreme. And then you get periods of time where you get dislocations where nobody wants to invest in a particular sector for some reason. A couple of years ago it was biotech, right? So a few years ago, biotechs were trading at extremely high risk equity risk premiums. That has since gone away. More recently, commodity type companies, energy companies. If you look at Alcoa, you look at Freeport McMoRan, you look at just energy companies in general. Up until a couple days ago, they were just going down every day, and that equity risk premium was expanding, markedly for those types of high, dividend-paying commodity and energy companies. The last few days seem to be catching a bounce along with financials. So, if you're getting paid like using Western Alliance as an example, because I mentioned them earlier, they're trading at 4.5 times next year's earnings. Clearly, some investors think that those earnings aren't going to be there. Otherwise, they wouldn't be trading at that valuation. There's again the concerns around what is credit quality going to be. If credit quality starts to deteriorate in financials, they have to provide more for loan losses, and therefore earnings go down. So clearly, there's a disconnect between what the companies think they're going to earn and what the marketplace is valuing them at. Basically, based on fear that those earnings aren't going to materialize in the next year or two. So.
Right. Okay, let's go to the next topic. We have already touched growth versus value companies. I think Jeff did a great job mentioning those different companies, right? So let's launch the next polling questions. Okay, let's come back. So I think this is the area where I think we should get help from Kamil, right? Kamil, so this is the impact of interest rates on the real estate. So I'm not going to discuss only the commercial real estate, but also the REIT, right? The REIT usually don't perform well when the interest rates are high. So what your thoughts are in the impact of interest rates on the REITs overall?
I mean, definitely where interest rate is today, it did chase out a lot of new home buyers because the affordability today is in question. and also the increase in valuation due to demand and due to the population shift that we had experienced since the beginning of COVID, where people moved from north south and they moved into the states that don't have income tax. Contrary to what the media told us, that people moved because of COVID, because there is COVID in Florida, there is COVID in Texas and in Denver and everywhere. So people did not move because of that. People moved because of other reasons that it is not the topic of today. We will leave that for another day. And definitely the residential real estate today is in question for new home buyers, or for those who are selling but staying in the same area, where what the value they are receiving will not provide them with the same quality home that they have sold. The best thing for them is to move to states where houses are less expensive, and that we have seen when people moved out of New York and New Jersey and Massachusetts. They went to the mid-Atlantic or to northern Florida, not Florida entirely, because southern Florida is very expensive, and also in some remote areas and outskirts of the state of Texas. In general, my concern is life after what we are expecting, that one day the interest rate is going to plateau somewhere, and then inflation will go back to 2 or to 3%. That is not going to happen, because in crisis management, and for myself as a dispute resolution advisor for many different industries in our world, and for ministries, and I tell them, when crisis persists for more than 6 months, don't expect things to go back to the way it was. And that's a sign that the crisis will protract even longer. And I have said that about the war of Ukraine 2 weeks in an interview that's still on YouTube, when I told them, if this thing is not stopped in the first 6 months, it's going to be a protracted war. Look where we are today. We're going on a year and a half. So, and pricing, going back to Costco and spending the same $200 or $250 to fill a cart that it used to be 2 years ago, that's not going to happen again. Because I just give Costco as an example, because it's in every house where the 4 of us and all our audience use. Costco adjusted the pricing of his leases, of the cost of trucking, of the salaries for their employees, of their insurance, and for everything else. So if the inflation can be contained at 3 or 4%, you expect the pricing of food and energy to go back to the way it was. That's not going to happen. So there will be a period where people will have to make an adjustment that will increase poverty, that will dilute a good segment of the middle class in the developed world. So all that together is going definitely to impact real estate, because all of us, our homage, our sanctuary starts in the real estate.
Right. Thank you, Kamil. So Steve, as we firm get involved and you get involved more on the real estate funds, how do you value those investments, right? Is there that you ask them to have a third-party valuation, and what's the impact of the interest rates on those real estate investments? What is the best practice in this area to value real estate investments?
Absolutely. So, as rates were low and the value of real estate was, it is whatever it was, you really didn't have to worry about too much, because you knew what you were getting just on the face of it. Now that we're seeing this huge impact, the interest rates going up, the prices have gone up. Should we be revaluing these things because there's the potential to see whatever percentage wind up on a bank's balance sheet and they want to get rid of it. You know, they're not in the business of wanting to hold these things. They want to just kick them off and, you know, not deal with it. For me, we've actually started to ask a lot of fund managers that have a heavy concentration in real estate to get a real third-party appraisal to include all these factors. Right? We don't want to, you know, we don't want to overstate what's on the balance sheet, but we also don't want to understate either. So if we can come somewhere, you know, if we can get a third party and, you know, it kind of validates what the auditors think or what the fund manager thinks, that's the best thing we can do right now in terms of valuation.
Thank you. So my similar question to Jeff is that, as you know, that as you mentioned earlier in your conversation, that the issue right now with the banks is the commercial real estate. So I know these loans will be have to reset the mortgage or not are going to mature in the coming months and years. So how do you see the impact of commercial real estate on the economy and on the banks and overall in the market? Is this manageable?
Yeah, I think it is manageable. I mean, you saw PacWest Bank sold $2.6 billion of construction loans a couple weeks ago, maybe 2 or 3 weeks ago. They sold $2.6 billion is a decent chunk loans. They were able to sell them to a real estate fund that has more permanent type of financing in place and take those construction loans off of their balance sheet. So that was a good sign for the marketplace that those loans cleared at a decent price. They were 95 cents on the dollar, which, you know, given where rates are, seems about right. You know, the construction loans tend to be floating rate, so there wasn't a lot of embedded interest rate risk in those loans. But it was a good sign for a bank that was struggling with its commercial real estate exposure. They were able to find a bidder for that portfolio. Again, I think you need to just, as Camille did, you know, you need to distinguish pretty clearly between different types of commercial real estate. You know, if you have and even with office, you need to distinguish between different types of office. So there's a huge difference between a downtown San Francisco office tower that Google's trying to get out of, you know, 200,000 square feet of, versus a suburban dentist office, right? If you have a dental practice and they have a suburban, you know, dental office, they've put a lot of money into building out that dental office, the equipment, you know, setting it up, building. They're not going anywhere until the lead dentist decides he wants to retire, and even then he's probably selling his practice to one of his younger associates, and that office isn't going anywhere. So those dental offices, even though they fall into the office category, are, you know, money good loans. You know, similarly, self-storage. I mean, there just continues to be, you know, tremendous demand for self-storage, for industrial, for general overall commercial real estate loans. You really need to dig into it. So, into what kind of loan is it? Now, if you have, you know, a portfolio of urban office towers, which Signature Bank did, there aren't bids for those. So, you know, good luck trying to move that loan book to the point where, when New York Community Bank took over Signature Bank from the FDIC, they put back about $40 billion of urban office loans to the FDIC. They just didn't want to take them at any price because they didn't know where to value them. It would just be an issue going forward. But other commercial real estate, you know, generally speaking, is doing well. Apartments, you know, senior housing. There's always demand for senior housing. Apartments in general. You know, if you want to build an office tower in Miami, there's financing for that. So you really need to distinguish what type of commercial it is. Now, that said, is there going to be a lot of pain when it comes to repricing fixed rate loans that were made 5 years ago that are coming due? You know, 5 years ago, you had a lot of insurance companies willing to make you a 3 to 3.5%, 4% fixed rate commercial real estate loan. That rate is today doubled. So your interest cost on, you know, your interest carrying costs are going up significantly. Now, if the value of the property over that 5 or 10 year period is increased via either your own work in upgrading the property or just because of general inflation, your loan to values might still be very attractive. That might be a current, 40 or 50% loan to value loan on the property. So you still may be able to refinance that with your bank, but your interest carrying costs are definitely going higher. So.
Thank you for your insight. I appreciate that. Okay, so time for next polling question. Okay, we are few minutes left, so I think after that, right, there is a evaluation which can be done at the end. But before we conclude our conversation, what would you recommend to the listeners if they have a $250,000 sitting in their bank account and they're happy to get the interest rate of 5% coupon, right, through the saving account or through the money market account? How long they should maintain that before they, and when they should put into work? Should they buy, what type of investments would they buy? So it's a twofold question. They have a $250,000 and you want to tell them keep it in the money market account, get the coupon. How long? And when they should invest, and when they want to invest, which asset class they should invest. I'm going to start with Jeff, then Camille, and then Stephen. Go ahead, Jeff, please.
Yeah, I don't think you're going to get that rate for very long. So I think it's if you look at inflation expectations, which haven't always been terribly accurate, but they're what the market is pricing right now. If you look at, there's a metric called 5-year forward inflation expectations that's traded in the marketplace. So people putting real money in making an estimate of what inflation rates are going to be in 5 years, and those are trading at 2.25%. So there's market expectation that forward inflation in 5 years, and between now and then is a long time, are going to be lower. But currently you can get 5% in some CDs. You can get 4.5% in a 2-year treasury, or you can get 3.6% in a 10-year treasury. Or you can buy commodity, you can buy commodity stocks or value stocks and get a 10 to 15% earnings yield. Now you might not necessarily get paid that because it has to come out in dividends, right? So if you want current income, I would suggest buying a 2-year treasury instead of a CD or a money market account, because you have upside convexity. If rates do go lower because there's an economic shock, we go into a recession, and the Fed reverses course and starts cutting rates, that 4.5% 2-year is going to suddenly be trading at 3%, and you'll actually get appreciation in your bond portfolio as well as rates reverse, and your money good if things stay the way they are. You have a little bit more risk tolerance, and I'm not a financial advisor. I'm a fund manager, so people give me their money and I make the decision, so I don't make any kind of individual recommendations. Never have, probably never will. Always been on the institutional money management side of things. What we're doing is we're buying bank stocks at 5 times earnings, 6 times earnings. We're buying preferred shares, so you can buy preferreds and financial stocks that are yielding 8, 9, 10% right now, which is very attractive for being higher up in the capital structure. If I was at my old shop where I ran a value mutual funds where I could invest in any sector, I'd be looking pretty heavily at investing in the energy sector, in commercial REITs that have been beaten up. So if you look at, some of the REITs out there are trading at distressed prices, and some commodity producers, whether it's copper or other commodity producers, are trading at, 5 times earnings, 6 times earnings. I'd much rather be there than be in the NASDAQ 100 right now, Nvidia or Apple at the valuations that they're trading at. It just doesn't make any mathematical or economic sense for them to be trading at the valuations that they are. But again, the stock market is this great place where things get irrational on both sides, and you can make those judgments for yourself as to where you want to be.
Kamil?
Definitely alternative investments. And I said that about ourselves as foreign investor and non-US taxpayer. We focus on capital preservation and growth. We find safe haven in alternatives due to the fact that they have low correlation to the market and also relatively liquid, but though they have a high purchasing cost and also difficulty in calculating the internal value, but they are much safer than the money that you have other people investing for you. And I must add that since I came here many years ago, the first time to the States to attend school, I've been watching that the US investor has progressed from the generation that relied on other people investing for them to today, just like my colleague Jeff had said, make your own decision. I find today more investors are capable of making their own decision due to education and the sophistication that they had acquired and improved in their skills. In alternatives, I mean, alternatives is not only commercial real estate. It could be renewable energy. I mean, I wish for people what I do for myself. I have a keen interest in investing in liquid hydrogen, improving into solar energy, into the production and improving the technology of photovoltaic panels. I see them now, as we all see. They are much smaller. They are easier to install and also have a much longer economic life. This is something that many people who installed 10, 15 years ago, they were not aware or they did not consider the economic life of what they put on their roofs. Today, the current production has a much longer economic life, and that also encouraging for investors. I also see private credit in commercial real estate and in manufacturing companies that have sustainability, for example, food production, and into agriculture, into producing food, into hydroponic production of food. So all that has sustainability that I would encourage investors to look into, at least for the 3 to 5 years down the road, to see how the economy going to adjust itself from within, because normally this is how it is done. I will stop here for the benefit also of Stephen to have his own day in court.
My day in court. Boy, they threw the key away a long time ago. So for me, it comes down to essentially what every investment decision comes down to. What's your risk tolerance, right? So somebody today might want to take that $250,000 and know that they're able to open up a money market account online and get in the neighborhood of 5% for the next 6 months or year, right? And they don't have to worry about any volatility, anything else. That's what they're getting. And when that time is up, maybe they turn around and say, you know what? I still don't like what I'm seeing. I leave it. I'm getting guaranteed 5%. Or prices have leveled off in the real estate market. Interest rates have come down a little bit. And I like the area that, I'm working in, I'm living in, my cousin is in, and I'm going to buy something long term. So for me, at the end of the day, it's all about what your tolerance level is.
Good advice. So Jeff was recommending bonds. Was this long duration bonds, Jeff? Just be on the
No, I would say the 2-year bond looks probably most attractive.
Okay. Alternative investments and Steve being conservative were more on the money market account. I would say thank you for everyone participating and educating our listeners, especially Jeff and Kamil. They took their busy schedule and start making money and helping participants. Thank you, everyone.
Thank you.
Thank you.